The other thing that a whole bunch of former central bankers are saying is don't use QE. Don't do it. And I don't have any more money in here, but don't do it. Don't do it. They see no proof that QE delivers any net benefits. And it's not just him. There's a bunch of them that are saying this. And central banks are now winding down portfolios amid rate hikes, which means that they are liquidating the bonds that they're holding on their balance sheet, and they're taking huge losses because, as you recall, right, interest rates, market value. So as they've been pushing those interest rates up, the market value of those bonds and all debt instruments have been declining. Central banks should throw quantitative easing out of the monetary policy toolkit because there's no proof that it leads to better economic outcomes. That's from a former International Monetary Fund chief economist. And I would put it on the shelf until we figure out more about it. They've been using it since 2008. But let's put it on the shelf till we know more about it. Because we are now starting to feel the impact of all of that QE. Let's see. So he was in the Reserve Bank of India from 2013 to 2016. I do not think the benefits outweigh the costs. Rajan said QE did work at the start of the 2008 financial crisis as a short-term liquidity tool, but in its current semi-permanent state has caused problems. It has led to more financial risk-taking rather than real risk-taking, which doesn't translate into more real activity, but does leave the economy more vulnerable. So what he's saying here is all of this free money that the central banks have been pushing out through QE, the corporations didn't take that money and expand their corporations. They expanded their trading, their risk-taking in the stock market. Because, hey, the Fed has promised, and not just the Fed, but the central banks have been giving lots of free money out. So we have lots of IPOs and lots of other risk-taking in the financial arena, but we haven't really grown the economy because it's not going into expanding businesses, just into trading, okay? Lower long-term rates were supposed to boost investment, but I don't think we see that connection. No, because they're trading. They're just using it to trade and make money, not to support the real economy. QE has been bad for public finances too by switching cheap long-term debt into expensive short-term borrowing. Okay, so the long-term debt, look at how this moves up and down as interest rates move. The short-term moves a lot more, is impacted a lot more than the longer term. It's the same thing when you look at the real estate market. And those of us that are sitting on mortgages under 3%, are we going to be anxious to sell that house and take on a 7% or 6% mortgage? No. So what that's doing is it's slowing down the economy, not supporting it. And that's what they're talking about. The corporations refinance longer term debt into lower coupons, but short-term lower coupons. And now they're having to refinance in a rising interest rate environment. It's a problem because they either have to come up with more capital to put down as they refinance, or they have to get less money than they owe. So can you see the problem? The Bank of England currently estimates that QE will end up costing the government over 100 billion, and that'd be British pounds, so 125 billion US dollars, as it's forced to cover losses on the vast holdings held by the central bank. Well, who really pays for that? I love when they say these things. It's going to end up costing the government. Well, who funds the government? Taxpayers fund the government. And what you're also seeing here is that central banks are out of tools. They keep talking about their tools, but they don't get specific because they don't have any more tools. Now, I'm not saying they can't make something else up, because maybe they absolutely can. I mean, I didn't see QE coming. I'm not going to lie, right? So maybe they can, but they certainly seem to be having problems doing so, don't they? And again, this all goes back to confidence. This is why they always test consumer confidence, inflation confidence, and expectations, those kinds of things. But if you look at the change in Americans' confidence in major U.S. institutions, the difference between 2021 and 2022, they have gone down in every single instance. Every single instance, confidence is declining. There's barely any confidence in the government left. Banks, now I don't think they did this before March. I think they did this actually before March, or this would probably be lower, but this is what we need, not we. This is what the central banks need to have happen, and the government too. They need to have public confidence in the banking sector. But that confidence in all of Americans' institutions, including the central bank, it's on the decline. But you know what I trust? Guess what I trust? Oh my goodness! Physical gold. Physical silver. That is what I trust. And how about you? It even says it on this bill that has my face on it. In physical gold and silver, we trust. Do you trust the central bank? Do you really trust them to do what's in your best interest? This is the kind of thing you need to be aware of, because this is really what's happening. Whether you see it, you don't see it, because quite frankly, they will keep these things hidden until it's too late for you to make a different choice.